Hi guys, Dibyosh again. So in my previous two sessions, I discussed definition of ratio analysis, purpose of ratio analysis, and then I discussed some liquidity ratios. Then in my last recorded session, I discussed what is cash and cash equivalents. In this session, I will be discussing another very important topic, both heavily tested in your CPA exams, in both TBS, that is task-based simulation, and your MCQs, and also very relevant for your practicality purposes. So without wasting any further time, let's go to that topic. What's that topic? Bank reconciliation statement. Now, most of you would say to me that, hey Dibyosh, we are doing this from class 11. You don't need to teach us. We know it perfectly well. My answer to you guys is absolutely correct. Everybody from commerce background knows this perfectly well. Perhaps you guys know it better than me because I have not been practicing it for very long. But you guys, like those of you working professionals specifically, you guys know it like the back of your hands. So what am I going to explain to you exactly? In US, they do it slightly differently. How? Let's go through it in next 20-25 minutes. Now, first, let's look at the definition that a bank reconciliation statement is a summary of banking and business activity that reconciles an entity bank accounts with its financial records. This means that any company maintains a cash ledger, cash and bank ledger, whatever you can call it, and they pass entries into it, the accountants. And bank maintain its own ledger. We call it bank passbook or bank statement. So by definition, bank reconciliation is a summary of banking and business activity that reconciles an entity bank account with its financial records. And I quote, they also say, the statement outlines the deposits, withdrawals, and other activities affecting a bank account for a specified period. A bank reconciliation statement is a useful financial internal control tool used to thwart fraud. Quoted. See, basically what they are saying in this slide, I know you guys know this statement like the back of the hand. Wait for 15 minutes. I will show you what is the difference with the US. They are saying what we all know, that this is the difference of reconciliation between bank statement or bank passbook and our cash book. That is the ledger we are maintaining. The statement outlines the deposits made in the bank, the withdrawals, and other activities affecting a bank account. Only bank. A bank reconciliation statement is a useful financial internal control used to thwart fraud. How? I gave my cashier, take this $50,000, go and deposit it in the bank. I forgot about it. My cashier passed immediately the entry. What is the entry? Bank debit to cash. He never deposited the cash. At the end of the year, when my CPA sat and was doing the bank reconciliation, he found there is a $50,000 missing entry that is present in my cash book, but not reflecting in my bank statement. I put some effort in my brain. That's a big amount, right? I could not sleep for 2 days. Then I remembered, okay, on that fine day, I gave that man $50,000. I said to that man, show me the deposit receipt. When you deposited cash with the bank must have provided you with a receipt. Since he had never deposited, he could not give me the receipt. So this make sure that your employees whom you are entrusting with your hard-earned cash do not try to mingle with it. Now, let's get straight to the point. Let me not bore you anymore with this topic that you are reading since your class 11 days. First, let's look at what Indian accounting system says. So here are some facts. Cash as per cash book is $20,000. I have taken dollar because US. Cash as per passbook is $13,855, and they gave you some other information. Check deposited but not cleared. Check issued but not presented. Interest income. Check returned due to NSF, that means bounced. Now, always presume that this is a check you deposited, because from a company's point of view, you will not issue a check to someone when you know that you don't have balance in it. Because these are huge companies, guys. You will become CPAs and you will work for something like Apple, Microsoft, Tesla, Goldman Sachs. These companies will only issue checks when they have sufficient cash balance. So always presume, even in the CPA exams, if they say check returned, don't assume that you have issued a check which has returned. Assume you deposited a check, customer did not have the balance. So check returned due to NSF, $500, and bank levied some dishonor charges, which in this case came to $45. Now, what do we do in Indian accounting? First, we take a base. In this case, it was cash as per cash book. Now, we make certain adjustments to arrive at the figure of cash as per passbook. What are those adjustments? We add those entries which have the effect of either, like we add those expenses which have not yet cleared the bank. First, why? Because when I was preparing my bank statement, I have already recorded those expenses. So my balance is reduced. And bank has more balance because those checks or those expenses never cleared through the bank in the right time, balance sheet date or a quarter date, whatever. So you add that up to arrive at the bank figure. And you add those incomes up which are recorded already in the bank statement, but you don't have any information of it until now, or until the date, cutoff date, balance sheet date, yeah, quarter date, yeah, whatever. Because your statement reflects many things. Bank sometimes gives you statement on the evening, and then you are just reconciling 6 or 7 days later. You don't just do it immediately. So you found there is a interest income and dividend income generally, which dividend income, why? Because in US, many customers give bank their standing instructions to collect their income, rental income or dividend income on their behalf. And on that, bank charges interest. Interest income is a very nominal thing, right? Bank credited interest in your account, a passbook. You are yet to know of it. So when you are taking your base cash as per cash book, you will add those expenses which are already debited in your book, but are not reflecting in the bank statement yet, because that has already reduced your balance. Bring it back up to arrive at the cash as per passbook. And you will add those incomes which bank has already credited to your account, but you don't know of it, like interest income. And if you go by the US rules, it also includes dividend and rental income, because you can give your bank standing order and bank will collect it on your behalf. So in this question, there were 2 entries which were supposed to be added as per the facts. Checks issued, not presented, $26,000. And interest income, which was credited by the bank, $400. These 2 entries you needed to add to your cash book to arrive at the passbook figure. What would you less? You will less those incomes which you have already credited to your book, but which are yet to reflect in the bank statement, like checks deposited but not cleared by bank on the due date. Maybe you deposited something on 30th of Jan, 31st was holiday, 1st was holiday, it got cleared on 3rd. It's a possibility, right? Then you will also less those that bank has already debited to your passbook. That means bank has already reduced your balance, but you don't know of it, like dishonored check and charges levied by the bank, which in this case was check deposited and not cleared, $32, check returned due to NSF, $500, NSF charges levied, $45, you reduce $32,545, you arrive at the cash as per passbook, 13,855. And this was your passbook figure, which was presented in the question to you. Now, you guys should tell me that what difference have you taught us, right? We knew this since our class 11 days. Cash as per cash book, you make certain adjustments and you arrive at cash as per passbook. This is what BRS is. In the US, they do it slightly differently. How? They don't want a reconciliation between your cash book balance and your passbook balance. They are not interested in that. They want the true cash figure. What is true cash figure? So suppose you are preparing the bank reconciliation statement after generally 5 or 6 days after the year end. So on that date, when you print your updated passbook, you will generally know that the check you had deposited is cleared. The check you issued, that is to suppliers, have been encashed. And even if they don't encash it, you have the sufficient cash. You will know what interest income bank has credited, and you will know what check got dishonored. So they are saying, don't tell us why is it different. Tell us what would have been the true cash balance if all these transactions were actually recorded. Now this seems something different, right? Always remember that this was what we knew. We only knew this. This is what US accounting system asks you to do. It will tell you, take your cash book balance separately, $20,000. Take your passbook balance separately, $13,855. These are two separate balances. Now, what do you do with the cash book? In your cash book, you will only make those adjustments which have already been done in the bank passbook, but you were not aware of it, which in this case is interest income. Interest income was already credited by your bank. Same example, same figures. Interest income was already credited by your bank, but you did not know of it. But now, 5 days later, when you are preparing a BRS, you know it. It got credited, right? You go and you make an adjustment. What adjustment? You will add it up because interest income bank generally credits to your passbook. That means your balance has increased. Now you have to find the true cash balance, increase your cash balance. You found out when you printed the passbook that a check got dishonored. A check got dishonored for $500. Bank statement has already been debited. That means bank has already reduced your balance. You did not know of this. Now you know. Reduce this from your cash book balance, $500. Along with it, the dishonor charges, $45. And you arrive on the left-hand side, a figure 19,855. Now you went to your passbook. You found out that the check which you deposited for $32,000, it got clear 2 days later. Add it up. Add it up. And the check which you issued, supplier encashed it on 3rd of Jan. Less it from the bank statement because on your books, you had already adjusted these two entries. Deposit and issued. Once you issued a check to someone, the accountant will immediately pass the entry creditors to bank. And once you deposit a check, the accountant will immediately pass the entry bank to debtors. So your books, you have already passed the entries. Adjust bank statement for it. Deposit will be added because bank statement would have increased bank passbook balance and issued will be deducted as bank balance would have reduced. On the right hand side, you again get a balance 19,855. Left hand side 19,855. They call it the true cash balance. This is your true cash balance. Neither 20,000, neither 13,855. This is what figure that goes into the balance sheet. Now you will tell me, what are they achieving by it, right? We were doing fine, pretty fine. We were reconciling the differences and we were letting the shareholders know. I am a layman. I don't understand your accounting calculations. I am a layman. Nothing to do with the accounting background. I just saw what you reported on the balance sheet. That is your cash book balance or your passbook balance. I did not understand why you added those, why you less those. I could not understand any of these. And further, imagine US companies, trillions of dollars, right? Apple, something around market cap greater than $2 trillion. Microsoft, also greater than $2 trillion. These two combined are more than the entire economy of India. And think of something like Berkshire Hathaway. What is Berkshire Hathaway? The company owned, managed by, not owned actually, it's a public company, but he has the majority of voting power. And he is the CEO for the last 55 years by the greatest investor alive, Mr. Warren Buffett. In last quarter, that is the quarter that just went by, March, his cash and cash equivalent was somewhere around $140 billion. Now imagine, this is 20,000, this is 13,855. You find the true cash balance is 19,855. You don't find much difference, right? $555 or $6,000. Imagine it is $145 billion. So when he deposited something, it would have been in billion of dollars. And he reduced something, it would have been in billion of dollars. This difference would have been somewhere around 5 to 7 or $8 billion. Now you think, what is $8 billion? Guys, that's a very big amount and more than the GDP of $10 billion, perhaps of very small countries and poor countries. And US GAAP is one of the stringent measures in the entire world. It wants investors to know everything. So when I am looking at a Berkshire Hathaway balance sheet, I don't want to know what is the cash as per their ledger. I don't know what is the cash or bank balance as per their passbook. I want to know what is their true cash balance. Because 3 days later, check would have been deposited, would have got cleared. Check issued, would have been encashed. Interest income, I would have known. And dishonor also I would have known. So why to confuse the users of the financial statements? Give them the true figure that was relevant as per that date. That's 19,855. And with this, guys, I am done with the session on your bank reconciliation statement. A very small session, but a very important one, because there was just a brief difference between Indian and US. What was the difference? Indian, we do a reconciliation. That means we explain the difference, why there is a difference between these two, of bank balance as per my ledger and bank balance as per passbook. In US, they say we don't want your reconciliation. Tell us what would have been the correct bank balance. And 3-4 days later, you definitely know. So that is the difference. And why they do it? Because US companies are huge in size. If you even include Apple and Microsoft, they are more than the GDP of entire India, their market capitalization. And one good example I gave you is Berkshire Hathaway, Warren Buffett's company. They have $145 billion in cash, guys, enough to purchase an entire TCS, 100% of TCS at current market value. Even then some cash would be left, enough to purchase some other small companies, 2 or 3. So imagine the amount of cash that can actually change hands. So they won't tell us the true figure. Don't tell us a reconciliation. And that was this session all about, guys. Until next time, see you guys, and hope you are enjoying this as much as I enjoy making it. Best of luck. Study hard.